Good afternoon. My name is Karel Arnaud from SIPS. Welcome to this first session of the ECME annual conference, discussing several aspects of Europe's capital markets integration. I can welcome a fantastic panel for our first session with Jennifer, who will be moderating a panel with two officials and two market participants. So two officials who are on the issuing side of that, Kalin and Niall. Kalin for the ESM, Niall for the European Commission, and then comments from Anne-Marie and Isabel from the market side. So welcome to all, and I pass the floor to Jennifer right away for what I will hope will be an interesting session. Jennifer.
Thanks very much, Carl. So just briefly to introduce myself, I'm Jennifer Laidlaw. I'm a financial journalist and currently write about ESG for S&P Global Sustainable 1, which groups together all of S&P Global's ESG offerings. So welcome to the event. And the big question we're going to look at today is looking at the market for EU debt and whether the EU is becoming sovereign. With the pandemic, the EU is financing its sure and next generation EU recovery packages through massive bond issues. And total issuance may exceed 1.4 trillion euro. And a large part of these bonds are actually green, so debt that's going to be invested in sustainable projects. And all this is making the EU a safe asset. And today we're going to be looking at a range of topics, such as whether the pandemic recovery programs are a game changer for EU debt, how the market is receiving EU bonds, and what role EU debt will play in wider markets with swap spreads and the green aspect of the bond program. So we've got a great lineup of experts to discuss the topic with you today, who will provide us with great insights, and we're looking forward as well to questions from the audience. So first up, we have Kalin Janse, who is CFO of the European Stability Mechanism, Isabelle Wiek-Philippe, Head of Euro Aggregate at Amundi, Niall Bohan, Director of Asset Debt Financial Risk Management at DJ Budget at the European Commission, and Anne-Marie Coldeveyer, Head of SSA and Covered Bonds in Global Capital Markets at BlackRock. So, Kalin, let's start with you. Now, how are the Next Generation EU and other funding programs related to the pandemic turning into a game changer for EU debt?
Yeah, thanks for that question, and thanks for having us, Jennifer and Caro, and a great panel. And I always like to start with a little bit of history, and I want to take you back 10 years ago, where we created a new Eurozone safe asset, which was the ESM and the EFSF. So at the start of the Euro crisis and the great financial crisis, we needed a response to the crisis back then. So we created a new institution, my institution, DSM, next to the Commission, who could do 60 billion of funding back then and couldn't do more than that for political reasons. We created the EFSF with another 440 billion capacity to create a firewall, 500 billion. Now, that is a bit of history because it is important to go back because we know that we have safe assets in the past. Now, the way we see it today is that you need to look at what Europe has to offer as a whole. In 2020, we had in total 800 billion of safe assets, Niall's institution, my institution, and the European Investment Bank, which is already a sizable amount. If you add what will come in the coming years, we will be getting to almost 2 trillion in safe assets that will be in the market, Eurozone safe assets. If you add on top the AA plus issuers, the strong countries like Netherlands and Germany, you're at 5.4 trillion euros. So for investors and for the market community, there is already a deep pocket. Is it enough? If you compare it to the US, it's much less. US has 90% of GDP, which is safe asset. In Europe, it's around 40% with all these issuances, but it is sizable. And you speak about a game changer. I do think that the Next Gen EU is a game changer because it is for the first time that next to lending, what we have been doing, what the Commission has been doing in the past, what the EIB has been doing, you now have really grants that are financed in the market and then transferred from countries that were less hit by the pandemic to countries that were harder hit to the pandemic. That transfer that is happening now on the Next Gen EU is a real game changer for Europe and something that has never happened before, that you finance in the market and then transfer across the continent.
Okay, great. Well, thanks very much for that. Anne-Marie, just moving to you as an asset manager, I mean, how do you see the market receiving the green bond issuance that's coming out from the EU? And what does this actually mean for the EU as a major green bond issuer?
So yeah, clearly the inaugural green bond from the EU mid-October was very well received by the market in general and also by BlackRock specifically. The total demand for the impressive inaugural deal was 135 billion and the transaction was 12 billion. So it was very well oversubscribed. And so in terms of demand, but also in terms of pricing, I think it was a big blowout. They obviously came with a greenium, as we often see with sovereign green bonds. It's always a bit difficult to quantify how large that is, and I won't go into much detail about that. But I think from both a demand and a pricing perspective, it was a really nice transaction. And as BlackRock, we were specifically keen to also see that they access the 15-year part of the curve, because we do not see that many long green bonds in the market, and this was really helpful for our liability-driven investments team. They have pension funds involved, and they like that long part of the curve. So yeah, overall, we are very supportive of the EU green bonds, and yeah, I think if we just look at the overall market in September, there was about 20 billion of supply in ESGs, and yeah, we see pricing benefits for sovereigns as well. So I think, yeah, this significant demand and even more attractive pricing will be very supportive for the EU going forward, because they will obviously be super active with about 250 billion of green bonds in the next couple of years. So that will make them the largest green issuer. And yeah, again, we are very supportive of that.
Right, well, let's go to the actual issuer. And I just wondered now, in your position at the Commission, you know, how do you see the role of EU debt playing on the wider markets, especially given that EU debt issuance remains smaller than Germany at the moment? And kind of what do you see the chances of that changing, like, over the longer term?
Okay, thanks, Jennifer. It's a pleasure to be back at SEPS, my former employer. So when Carl whistles, I tend to come running. So here I am. If you don't mind, I'll take maybe a couple of minutes, maybe just to kind of take on the issue that, or the tagline for this seminar is the EU as a sovereign issuer. Just recalling that back in 2019, we issued 500 million euros in debt, and in the last 12 months, we have issued 180 billion in bond issuance, and then another 22 or 25 in bill issuance. So something has happened. Clearly, what we're doing here to fund the SURE and NGU programs has a very strong social economic character, and I think the investor community has understood this and engaged with this expression of European solidarity and cohesion, and I think that has really been what has powered us or made it possible to get to this scale so quickly. In approaching it as an issuer, we had to adopt many of the mechanisms that a sovereign issuer has used to issue this sovereign volume of debt. So we've built a primary dealer network with 42 banks. We've launched the EU bill program. As I said, we've issued 25 billion in bills since September. We've now started some bond auctions. We have a very structured communication with investors through funding plans, and we engage with our member state peers, the debt management offices. And finally, I think we've made a conscious effort to broaden our investor base, to reach investors across the world. 13% of our SURE bonds are sold to overseas investors, and about 10% of the next generation EU bonds. So we have a much bigger book of investors as well. In addition to that, we have, as Anne-Marie just mentioned, launched a green bond issuance program. Like 13 member states with their sovereign bond issuances, we're now also trying to put our brick in the wall of sustainable finance markets with this NGU green bond issuance. First transaction you've heard it described. Our ambition with this program is to roll this out steadily. So we have about 240 billion in eligible green bond expenditures, we think, to finance 3 green bond issuance over the next few years. And we'll try to build a liquid curve for this green bond from 5 out to 30 years. So that's the ambition we have, really, to set the EU as the benchmark green bond issuer. So in many respects, there are a lot of similarities with a sovereign issuer. However, it's still worth bearing in mind that what we're doing here, unlike member states who have rolling financing needs, we are issuing to fund very delineated policies. SURE on the one hand, our next generation EU recovery fund plan on the other. That has 2 consequences. One, our issuance is very closely linked to what the expenditure needs are in time and in amounts. So we have to phase our issuance so that it closely tracks the expenditures. We have decoupled a bit. We are using liquidity solutions, the bill program notably. So we're never, our issuance is not tied on a day-to-day basis to our funding needs. We have some liquidity management capacity, but that is really crucial to smooth successful delivery of this issuance program. And the other big difference, of course, is that the new debt issuance will stop in 2026 for the NGU. There'll be a lot of refinancing beyond that for the next 10 years beyond, so we will be a regular, strong presence in the market, but the debt issuance will start to taper off after 26. So that's, I think, worth bearing in mind when debating this question about is NGU a safe asset or not. We are not in the market just to issue debt for the sake of it. We're there to issue debt to fund very specific or identified policy needs. Maybe just to conclude then, having said that, I think what this experience has shown is that there is a huge appetite for highly liquid, highly rated EU debt. We have, I think, with the consistent huge levels of oversubscription in excess of 10 on average for both the SURE and the next generation EU transactions. We're clearly speaking to a very strong latent need in the market. So this asset is very, very much desired or wanted, and you see a different mix of investors in the marketplace now, including a lot more investors looking for liquidity, bank treasuries, and so on and so forth. The liquidity in our instruments has gone up hugely in the past year, and is about now on a par with that of the sovereigns. So 15 to 20% of our outstanding debt is turned over on a monthly basis. I think that's a big difference compared to where we were a year ago. We've also shown that this can happen without crowding out member state issuance. We're not spoiling the market for member states. On the other hand, I think we've learned to work very well together in close concert, and that is because what we're doing is funding complementary needs at a different level of government. And then I conclude maybe just by repeating, I think the key to that is this clear understanding that we are a distinct issuer coming to the market to fund these very identifiable social economic recovery needs. And now we have added this new sustainability and social twist to it. And I think that has just turbocharged the market interest in these issuance programs, and I think there's a lot of lessons there to be learned for the future. Thank you.
Okay, well, thank you. Excellent. That's a really sort of good introduction into the EU's thinking. Isabelle, I'm just going to turn to you. I just wanted to ask you, how is EU debt positioned in terms of like recent swap spreads? And, we've been talking about EU being a safe asset. I mean, do you think like over the longer term that EU debt is going to be considered as sovereign?
Thank you, Anne-Marie. Thank you first Jennifer, sorry. Thank you for inviting Amundi to this panel. I've prepared some slides. Do you see them? Okay. In fact, all those slides you will see are supporting the messages that has been just conveyed by Niall. First, if you look at from a market angle, just a market angle, if you look at the recent price action in the fixed income market, you can see on the first slide that there has been a very strong appreciation, reasoning of sovereign debt versus swap. So here you have for the main maturities 2, 5, and 10 for Germany and France. And it's telling us a lot in terms of how safe an asset is considered by market participants. So there's currently a clear search for safe assets in the market. It's usual at the end of the year, and there are several reasons to this. It can be flight to quality or safety. It can be a question of scarcity. It can be also a question of collateral needs. And here you have on the right chart the evolution of the 3 months German repo rate, which is very correlated to what occurred into the swap spread and the reasoning of the short end part of the French and German curve, which means that there's obviously something on the collateral side and needs from the market. And collateral needs, they are expressed on the assets that are deemed the safest, including both aspects, quality and liquidity. On top of that, if you there can be some elements very specific in terms of scarcity to explain the behavior of Germany. And you have here one chart that illustrates, let's say, one aspect of the scarcity in the German debt, which is the calculation that is made by the ECB in terms of free float that is in the market. So you see that there's around 10% of German debt that is available for all investors. And when you need to have to hold those papers to put them as a collateral, it can pose an issue. And so for EU, it can be a chance to get that status. And if you look at page 4, how the EU debt is positioned with in that regard, it can be seen as like a barometer of the EU status by market participants. So you see that in the 5-year maturity, you have on that chart in green Germany, in red France, and in blue EU. You see that EU has had a similar pattern than sovereign versus swap. So a trend of getting more expensive versus swap during this period, but with some differences. It's a smoother profile, and the magnitude is less important. And if we look at the liquidity aspect, because maybe there's a part of it that can be explained by the difference in liquidity between the EU debt and the sovereign debt, you have on this chart the evolution of the bid-ask spread for EU for another very large supra issuer, which is EIB, and for a sovereign, which is France. And you see that the fact that EU has become a large issuer has changed its status in terms of liquidity. It's very obvious. It was trading above EIB in terms of bid-ask spread, and since the introduction of the SURE program, and it has been reinforced by the next generation EU issuances, clearly liquidity on the EU debt has increased significantly and is now much better than the EIB liquidity, and it's getting closer and closer to the sovereign debt liquidity. So from that aspect, EU is getting more and more close to a sovereign status. I have to highlight what Kalin has mentioned, which is the fact, and also Niall has mentioned, that I believe that the fact that the EU debt program is with an end date, and then afterwards there will be only there will be only refinancing, is a feature that will maybe prevent EU to achieve a similar liquidity than France or Germany, because there's first an uncertainty on the amount that will be issued by the EU. We don't know whether all countries will take all the loans they can get from the EU. This is the first point. And then the fact that there's an end date that is already set up. For the time being, the market is still looking at, let's say, the short-term horizon. EU is now a part of the safest assets you can buy in the market. But as we will get closer to 2026, this question will be raised. But in the meantime, we don't know whether there will be changes in the missions that the EU has.
Okay, great. I mean, very interesting, this concept of the end date. And Marie, I'm just wondering, is that something that you're seeing as well from investors?
Completely, yeah.
Yeah, this preoccupation with the end date, you know, when is this actually going to end?
Yes, so first of all, I completely agree with Isabel's analysis. I think it is all about liquidity, and I think what has been quite helpful is that the next generation EU bonds were slightly larger. I believe the share program bonds were kept at 10 billion, and that made the free float after the ECB purchases, made the free float relatively limited, and that made it more difficult in the repo market. But I think with the next generation EU bonds being larger, the first one were I think it was 20 billion, and the green bond was 12 billion in size, and that makes the free float larger, and therefore this has been really good for liquidity purposes. I think if you look at the EU not only doing syndications but also auctions, and that's also of course a bit more sovereign style. But at the same time, if we look at how banks see this, I think often the EU is still being traded from the SSA desk and not the government bond desk yet, and I think that has to do with liquidity. And then indeed, to come back to your question, Jennifer, I think it is all about the future of these EU bonds and what will happen after 2026. I think that is the big question, obviously, and that will also determine whether the EU is going to progress towards becoming more sovereign style. So yeah, I agree.
All right. Okay. Just now, any comment on that, particularly about this end date? I mean, is this something that the EU may consider changing in the future, or, I mean, how do you see things evolving?
I think next generation EU recovery plan funding was the product of a very lengthy and extensive consideration by heads of state and government, and they agreed on the very precise parameters for this program, and it's a temporary and exceptional response to temporary, hopefully, and exceptional events, notably the pandemic. So in that respect, let's say the expiry date, the sort of fixed shelf life of the new debt issuance was part and parcel of this program from the very beginning. We have built this machinery so that it will get us through these vast amounts of new debt issuance, 150 billion a year between 21 and 26, and we needed a new apparatus to do that. And beyond that, then it is all we know is that there will be extensive refinancing needs in the following decade. So NGU debt is going to be in the market into the middle of the century and will need to be serviced. So we will be there to do that. All I can say is we have through this experiment, let's put it like that, shown that borrowing can be a useful complement to the EU budget in dealing with, let's say, longer term funding needs where sometimes dispersion of the expenditure over time is useful. We've shown that we can do this, that we can build a machinery. We can show that there is huge market demand and latent interest in this, and that the EU, either the Commission or ESM, EIB, we have now established ourselves internationally as recognized investors. So there are lessons learned to be drawn if people are thinking about future policy uses of this exceptional borrowing. But for the moment, we are just getting on with the implementation of the next generation EU on the terms on which it was agreed in July 21.
Okay, fantastic. And Caroline, have you got any comments from your position as a regulator, regarding this end date and refinancing for the years to come?
Well, I want to look at it from two perspectives on the safe asset. So first of all, you need to define what you mean as a safe asset. If you mean that you want European debt to come to the market, we do have these three safe assets. The European Investment Bank, supported by 27 countries that finance projects across Europe. We have the ESM that helps in financial crises and Eurozone crises for the 19 countries of the Eurozone with loans. And then you have the next gen EU and the crisis response that was for the pandemic. That is another 750 billion plus the 100 billion of SURE. As a European, you want Europe to solve problems for you, and you don't really care whether it's us or NIO or the European Investment Bank, but you need different tools for different crises. If you look at the current pandemic, we are hit by symmetric crisis. Everyone in Europe is hit. It doesn't matter whether you're North, South, Eastern European. If you look at the great financial crisis and the Euro crisis, there was a divergence. Some countries were less competitive, some were hit more, and therefore you use the ESM with a different toolkit where reforms and restructurings were needed. Now, for the market, they look at, are you buying a blended rate from 19 countries, or are you buying a single risk to Germany, Netherlands, Italy, Greece, Spain, Cyprus? If you want to buy a blended Eurozone bond, well, then you buy us, because we're the only one that has the 19 countries of the Eurozone. If you want to buy a EU 27 blended bond, you buy NIO, the European Commission, or the EIB. For traders, this is how they distinguish them, and you see that they go through curves, and sometimes they're more expensive or cheaper than we are. So this is, I think, how the market responds to it. Now, what is important for me, if we start looking forward, is that Europe has built an architecture to deal with crises. If we're hit by another symmetric crisis like this virus, we have an experience with Next Gen EU that works and that is successful. Imagine the next crisis hits only 1 or 2 member states, and they need to reform, they need to restructure, they need to go through some of the painful exercises that we went through 10 years ago. You have the ESM available with another 410 billion capacity. So you need to use this architecture and this toolkit in order to solve crises in Europe. And yes, all of that brings safe assets into the market, which will be 2 trillion in the coming years, but we have empty lending capacity of the ESM, another 400 billion, which could be 2.3 trillion. Who knows what next will hit us. So I am very confident that what we now have in the market is successful, as mentioned by Isabelle and Anne-Marie, but also by Niall, but also that we have tamed down markets, and that markets actually believe that Europe is able to answer to crises. And one chart that Isabelle didn't show, but I always show, and it builds upon her last slide, is that every time last year that the policy decision was made, the 540 billion first response of the Commission, EIB, and ourselves reduced spreads. Yeah. When the Next Gen EU came out, it reduced spreads further. And if you now look at the spread between Italy and Germany, it's around 80 to 100 basis points. Only 1 year before the pandemic, in 2019, it was 250 basis points, 300 basis points. So we have gained trust globally. And that's why Niall also has all these Asian investors coming into his book, and also in our book, because they have regained trust in the market. And Europe is back, and trust is back in Europe. And I think that is the main message from European safe assets.
Okay. You got any more, Isabelle? You seem to really pick up on what Colleen was saying. Is there anything else you want to add or about the spreads?
No, I fully agree with what Colleen has said. I agree that we have an architecture now in Europe that is strong, and that we have shown also that we were able to move forward and to cope with different type of crises that we had to face, and so it's a great plus for the future if we were to have another type of crisis. And I agree that for foreign investors to have such a type of issuers is a plus, because for them, even though they represent 27 or 19 countries, in the end, what is very important is that in terms of credit rating, they have a similar credit rating and credit metrics, and the way rating agencies are assessing the credit rating of EU or ESM is very telling. And I think that we have now, with that type of issuances, a real type of bond foreigners can buy without looking in depth at the different specificities of each sovereign, which for them can be a nightmare, or they can focus only on, let's say, the safest one according to credit rating. So for them, really, it's a new tool that is very useful and with a lot of trust, and it reinforces, and I agree with Kalin, the trust into the currency and into Europe as a whole.
Yeah, so we're really getting to a point where it's going to really make the euro like an international currency, correct? Okay, excellent. Right, now one thing that has sort of stood out about this particular bond issue is that the EU is becoming more and more involved in sustainable debt, and these recovery programs, you know, include a large issuance of green debt, as we've mentioned earlier. And you know, the EU is a leader in sustainable finance throughout the world. It's really setting a roadmap for sustainable finance. I just wanted to go to you now and sort of, if you could explain like the thinking behind having, you know, I think it's a third of these bond issuance in green debt, and you know, there is a EU green bond standard that's being set up at the moment. If you can just explain why, you know, these bonds are not aligned to this particular standard, and just a bit of the thinking behind the green financing aspect of the EU recovery programs.
Sure, very happy to do that. It's something that's very important to us in the Commission, to try to use the opportunity that we have here to establish the EU as a leader in terms of the green bond stakes. I just recall that of the year-to-date issuance of ESG bonds, Europe is really leading the way with over half the global ESG issuance so far this year. And in Europe, 60% of that is accounted for by sovereign government, sub-sovereign and supranational issuers. So I think the public sector in Europe collectively is really using its possibilities open to it, because they manage such large programs of expenditure, which they can influence and orient towards climate relevant expenditure or socially supportive activity. We can make a difference here, and I think that's the driving force behind what we're doing. We're not chasing greeniums. We're really just trying to strengthen, consolidate the EU sustainable finance markets. What we're doing with the next generation EU green bond program, we know, we can see, we've been through with a fine tooth comb 26 member state recovery plans. We know that they have booked in excess of 240 billion euros of climate relevant expenditure there. So that's part and parcel of what they will be spending the money on. We can track it line by line. We know what is being spent on renewable infrastructures renewable energy or clean infrastructure, and so on and so forth. So we are able to pull that out of the member state plans, track it on the basis of 6 monthly reports from the member states, what they have spent on these items, and verify and control this process. That puts us in a very comfortable position that we know that we can control. We control a very large pool of eligible green bond expenditures, against which then we will organize the issuance of the corresponding amounts of green bonds. We will do that in a very careful way. We'll never anticipate. We'll always underissue compared to what we expect to be dispersed or spent on climate relevant expenditure, so that we never overissue and then have to explain ourselves to investors. We recognize that the biggest risk that we face in this exercise is not being able to account properly for how we use the proceeds of a green bond issuance. So that is something we're really investing a lot in, to be able to do that disclosure, use of proceeds, and later the impact reporting. On your point on the green bond standard, we have tried to align ourselves as much as possible with early versions of that, including a heavy use of the climate taxonomy. An awful lot of the expenditure that I just referred to is actually going to be very closely or will map into the climate taxonomy. There are some expenditures like climate research or upskilling and stuff, which the climate taxonomy does not cater for, because it is, let's say, by a corporate investment capacity driven taxonomy where you measure certain climate metrics or impacts. That's more difficult to do with research or social skilling, labor force measures. So there are things governments are spending money on that are not catered for in the taxonomy. Hence, we needed to bring a bit of a broader perspective to the taxonomy in building our own framework. But the bottom line is the opportunity that we have to launch this green framework exists now. It's not going to, and we're not going to wait 2 or 3 years for this green bond standard to get adopted by the Council and Parliament. We need to go now and take this opportunity now and establish EU as a leader now. And that's what we've done. And I think the reaction that you heard from Anne-Marie from BlackRock is extremely encouraging and important for us, showing that we're on the right track, not just on the first transaction, but on the second, third, the fourth. We have to do that to match that every single transaction and keep the trust of the investor base as we go through this, what is potentially the biggest green bond issuance program in the world.
Now, Anne-Marie, in the beginning, you'd mentioned the greenium. Is that something that you would expect to continue as time goes on? I mean, how important is it that the EU is involved in kind of green bonds? How does the market view that?
The greenium, well, the thing is, how do you define it really? That's, I think, the first question. I think what we saw with the inaugural green bond is that the greenium at issuance was I don't know, maybe 1 or 2 basis points max. And I think if you then look at the performance in the secondary market, that is more significant. And then you do see that there is a greenium. And we have a lot of debates with banks on how large is that really. And I think part of it is also well, if you look at just the sovereign market in general, sometimes it's also a bit of scarcity that is in there. So it is quite difficult, I find, to quantify. And it will be very interesting to see with the second green bond from the EU, how much they will price that in and how tight they will go versus the brown outstanding curve. That is not something that we are that much focusing on. Of course, pricing is very important to us, but we also have a lot of dedicated green funds that are eager to have more EU bonds in their portfolios. So I think that is most important to us. And then I think, as Niall also said, for us it's also really important that the green bond framework is very solid, and that the ambitions are high, that the thresholds when it comes to CO2 reductions that they are ambitious, and also that there's clarity around the exact use of proceeds. So we have a dedicated ESG fixed income team that actively monitors, not just the EU obviously, but for many issuers, how the proceeds are, what the exact proceeds were. And we look forward to also receiving these impact reports from the EU, and that will be very important for us also going forward.
Okay. Excellent. Kelly, I just wondered in terms of, in terms of taxonomy things. Isabel, please go ahead.
No,
Isabel,
I just
wanted to say something.
I wanted to just say something. For us, having the EU issuing a green bond and becoming a very large issuer, building a curve with liquidity is very important, because we also manage pure green bond funds, and having recourse to an issuer with a very high rating, a very high quality is very important in terms of portfolio construction. So it's a pleasure to welcome EU on that market.
Okay, fantastic. And Kelly, I just wanted, from your side, how you're seeing the importance of having like sustainable debt within the EU, and how maybe that contributes as well to it being like a safe asset or more considered by investors.
Yeah, no, a very interesting question, and I think you introduced me as a large issuer. But we are also the most capitalized IFI. So we have 80 billion paid in capital that we invest in the market. So I'm also in charge of investing these 80 billion. And over the last 2 years, I went up 10 times more in ESG investments. So we had back in 2018, only 450 million invested in useful proceed bonds or green and social bonds. In 2020, this was 4.5 billion. So we went really up 10 times, and we signed the UN PRI framework. And for me, this is very important. And we buy also NILE's bonds, and we also buy other green bonds. And I want to build upon what Annemarie said, and then I'll come to the taxonomy. 3-4 years ago, the greenium did not exist. Most issuers would issue a green bond or a brown bond at the same price. The best way to look at how greenium developed was a year ago when Germany issued the dual tranche bond. They issued a brown bond and a green bond, and investors accepted 1 basis point less of return if they bought the green bond because it was a green issuance. If you look at the performance, as Annemarie said, now that bond is trading 8-9 basis points away from the brown bond. It means that it's performing much better, and therefore, as an investor, you accepted less return in the beginning, but now you're really more profitable. So you're gaining more benefits. And I try to explain this also for the non-technical audience. The same is happening with the green bond of NILE. It went with 1 or 2 basis points to the curve. How you set that is a bit of a calculation method, as Annemarie mentioned. Now it performs 5 basis points or so better than at issuance. So there is a real benefit in buying those. Your second question, I think, is the most relevant one, is the EU taxonomy and where do we go from here? At the moment, more than 50% of the global issuance in ESG comes from Europe and is euro denominated. If you look at the taxonomies around the world, Europe is really leading. Actually, China is the one that is more advanced in the US in their taxonomy development because they're actually more ambitious than the current Biden administration is. Earlier this year, I wrote an op-ed with an American professor, Annie Bradford, that she wrote The Brussels Effect, a very popular book in the EU world, where Europe really starts setting gold standards. And what I see now today is that if you want to be an issuer in the ESG market and you want the gold standard, you go for European standards. So you try to list on the European exchanges like the Luxembourg exchange, or you try to comply with the EU green bond issuances and green bond standards, whether it's ICMA today and in the future it is the EU taxonomy. If we want to fight climate change, if we want to make the world greener, I think Europe is really the gold standard, and hopefully we can export this product across the globe.
Yeah, it's going to be very interesting to see, I think, what's going to happen over the coming months and years, especially, integrating EU or really like making the EU like the global leader, which is, I think most people agree that it is that already anyway. So it's going to be interesting to see what happens over the coming years. I just wanted to sort of step back a little bit and look at the, we're talking about the EU, and I'm just wondering, in terms of like other countries, because obviously the EU is made up of lots of different countries who also issue their own debt. And I'm just wondering, Annemarie, what are you seeing in terms of issuance from like individual countries? For example, I think Spain has maybe reduced its sovereign issues. Is that correct?
Yeah, it's a really good question again. So I think just the overall market, we've seen that sovereign supply has been a little bit lower. That has been quite supportive for spreads as well, just to come back to our story earlier. And I think indeed, as you said, Spain, and that was quite a couple of months ago, indicated that for them, the sovereign supply would very much also depend on the Next Generation EU proceeds. So they actually linked the two. If I'm not mistaken, they have been the only ones who've actually made this really explicit. But I think it's also quite difficult looking at the other countries to make a distinction between, what part of the lower supply is because of Next Generation EU and what part is just because of the lower fiscal deficits, because we have seen obviously that economies are doing much better, better than anticipated, and many countries have quite good cash balances, and that is in the end a big driver, of course, of the funding. And I think because of the lower fiscal deficits, supply in the fourth quarter has been a bit less than what we initially anticipated, and it will be very interesting to see what will happen in the next couple of months. I think, to come back to the EU, as we mentioned before, because of the loans, the grants have been very popular, but the lending, and that will of course be a question. And then looking at sovereign supply, I think it will depend very much on fiscal deficits, and that's not just for the EU. That's also, for example, for the UK, who cancelled quite a few of their government bond sales, mostly auctions. So I think, it's difficult to quantify what part is because of the EU and the Next Generation EU funds, and what is because of the fiscal deficits being lower. But we do see that there is an impact there.
Okay. Anita, I'm just wondering, from your point of view as well, as an asset manager, what are you seeing in terms of like debt issuance from other countries? Obviously, Germany, France, right? Big issuers. I mean, would you expect like the EU to maybe sort of come into competition with them in any way in terms of the size of issuance, or do you expect like Germany will still be like the largest issuer within the EU?
No, I think that some sovereign will remain the biggest issuers. And I think that in the ranking, you have France and Italy leading, and Germany just afterwards. EU being in between Germany and Spain. So as Anne-Marie has mentioned, we don't know yet next year's figures, but normally the ranking won't change a lot, depending if you look in gross or net debt issuance, there can be some differences. And I don't think that there will be competition. I think at the first stage, it was a question we had together with Nile, whether there will be some troubles to issue such a big program, especially for, let's say, the non-social or non-green, so the non-ESG bonds. But in the end, there's a lot of demand, and I think the fact that a lot of overseas investors are investing in EU debt is a great support, and it's a great achievement. And we go back to the question of Eurozone credit worthiness that has been increased by those new issuers, and the safety net they are offering to Euro members states, and to the status of the currency as a reserve currency. So it's a great plus, and I'm very happy to see that there's no issue and not a lot of competition between the different issuers, EU on one side and sovereign on the other one. Afterwards, beginning of the year is always crowded in terms of issuance, so we'll see beginning of 2022 how it evolves, but I think it will be on a similar pattern than the one we had this year.
Yeah, exactly. As we're coming towards the end of the year, we'll see what happens. Now we've got a question asking about, is the issuance of common debt a step towards fiscal union? And what do you think about this? Is this something that you think is going to happen? Would anybody particularly like to take that question, Colleen?
Yes, no, I saw the question in the chat, and I think it's a very good question. I always respond to it in the following way. If you look at the EU always has been a fiscal transfer union. I say that as a Dutch Bulgarian. The Dutch side is that you pay it more. Bulgaria always receives more than it pays in. So if you look at it, poor countries always got more money out of the EU than the rich countries that paid in more for it. So, and it has a real GDP effect. You see that these transfers actually create a 3, 4, 5% GDP bump because to the poorer countries of the EU or the countries that need it, like Bulgaria or Romania and other countries. So we already have some sort of a fiscal transfer built into the budget. Now, what is, I think, new to this Next-Gen EU is that for the first time, the EU can borrow in the market in order to do this financing. The budget was contributions from countries of the EU. Now, the European Union can borrow in the market and will have in the future, if everything goes well, own resources or taxation in order to repay those. That is a real new thing. So are fiscal transfers there? Yes, from the beginning when the EU was set up 60 years ago. What is new to this is really this borrowing capacity and potential taxation capacity that is coming up in the coming years.
Now, do you have any particular comments about that? It's from the EU.
Yeah, just quickly, fiscal union. Well, maybe there's a definitional issue here at the very start, but it suggests a lot of autonomous tax raising and fiscal powers, which the EU budget does not currently have, or only to a limited extent through some own resources. So I think that is a very big term and a very big discussion. I think what we can say is the EU budget remains small as a percentage of GDP in traditional terms. What we've seen with the recovery plan is that by augmenting it with a relatively small additional amount of borrowing up to 0.6% GDP per year as the ceiling for the whole NGU borrowing, you can actually achieve a lot. We have, through this, implementing a recovery plan worth 5% of GDP over the period to end 26, which I think, as Callan rightly says, involves, for the first time, a very explicit, overt desire to help the countries hit hardest by the crisis. So here we have a very strong redistributive element in the recovery plan, which was intended, and I think it was that cohesion that is the really powerful part of the recovery plan story. So I think, without getting into deep waters about fiscal union, I think what this experiment shows is that with a modest budget, you can have a disproportionate effect by augmenting it in a sensible, calibrated way through this borrowing. So I think that's the reflection for the future fiscal architecture of Europe.
Maybe just one last question for you as well, just regarding this, because we are running out of time. But I just wondered as well, in terms of like regulation, bank regulation, banking union, what do these bond issues actually mean for like bank capital charges? How does it help them actually gain enough capital to have enough capital on board?
Yeah, I just to draw a link then with the last question, I think this issuance program has a lot of spin-off benefits in terms of the sort of international capital market recognition of the euro, providing this international benchmark asset alongside the Bund and the Oat. We have something else that international investors recognize they can trade in and out of for diversification purposes. We have the inherent fiscal stabilization or central stabilization effect for the budget for the first time through this recovery plan, which in itself has, as Callan already mentioned, helped avoid flight to safety at the beginning of the crisis, kept interest rates in a very narrow path, avoided the kind of negative dynamics we saw in the sovereign crisis. So in itself, the recovery plan, by stopping that dynamic dead in its tracks, has already contributed significantly to help the EMU through what is an unprecedented situation. And the third leg of this, I think, would be, yes, we have this new issuance program of up to a trillion assets in this highly liquid, highly rated asset, alongside the other safe assets, sovereign safe assets in the EU, euro-denominated safe assets. It's not going to break the sovereign doom loop in and of itself, but it is there as an alternative to the local sovereign debt issuance for countries or for banks looking to strengthen their balance sheet or hold safe assets or liquid assets that are not issued by their own sovereign. And in this way, it can attenuate that doom loop nexus that we saw kick in 2011, 2012. Just to recall that NGU is at the margins. Nevertheless, I think it's interesting that around 25% of our issuance is being bought by bank treasuries and banks. So it'll be for posterity to judge whether this actually made a difference or not. But an interesting PhD thesis for Carol or some of these colleagues there to work on. Thank you.
Okay, fantastic. Well, unfortunately, we've run out of time for any other questions, but I'd like to thank everybody for taking part today. It's been great hearing your opinions and your ideas about everything. So thank you very much for taking part.
Thanks also from my side, from ECME and SEPS. I think you responded to many of the questions we had. I think there were certainly more, but thanks a lot, Jennifer. It was a very interesting panel. I think there's still a lot more to be said, as Niall said at the end. There's certainly a lot of stuff for a thesis on how treasury functions work in banks, for example, and how the debt is spread over different investors. So thanks a lot, Niall, Kalin, Isabel, and Anne-Marie on our side.
You're welcome.
Bye.
Thank you very much.